in terms of at least specific stocks. Let's get in some market perspective. Earlier today, we did speak to Ajay Srivastava, Chief Executive Officer at Dimensions Corporate Finance Services, to discuss the best stocks to invest in, Indian IT stocks, and the do's and don'ts of how to get the best returns. Listen in.
I think for most people who do on a salary side, the best thing is your PF. PF gives you the best returns compared to all the debt mutual funds. So I'm not suggesting debt mutual fund at all. I've been suggesting that you look at your PF, you look at your debentures that are available in the market, look at even government bonds. They give a better yield at this point in time. State government bonds, you can buy from the RBI window directly. You don't need a broker for that. So multiple options. Debt mutual fund, I would put the last or lazy options. If you're a lazy investor, you go there. So I would suggest to people is either stay away from buying, or if you really need to spend your money, do it the right way, spend it on holidays. Equity is not the place where you're going to be happy in the next year. Only long-term investment I find in this world, and including India, is commodities companies. Because there are few, and who are there are monopolies. So if you were to ask me in equities, only one long-term bet I can still go for, and I'll still keep investing, is the commodity companies, both India and abroad. If the recession in the West comes, the rest of the market will also go down along with it. So I'm saying if you need to invest in this market, and I would sincerely believe the commodities is still the place to be, then commodities has to stay firm or go up. Because yes, recession will put it down, but also what it does, recession, is that it will take away new explorations, new sites, new mines will not be explored any longer. IT is a good for India. It's definitely good for India. The problem is that you have to be clear about what stock you select. In India, we basically believe the top two are the only ones to look at. The rest have been laggards. They do perform sporadically, but they're never given consistent returns. I would say if you were to put in IT, hold this money for some time, keep watching the US market, and if you get a democratic government again in next year and a half time, you need to exit your IT portfolio because that's disaster. This is what has happened post-Trump in the US. IT companies are now facing the biggest disaster. If next president also becomes Democrat, you run out of the US market if you have not already run out of it. I think for investment, more than just chasing sectors, I think we can have very good stories which we have given good returns and they give you a chance to enter. So look at Yes Bank, look at Ambuja Cement, what happened. Look at Eureka 4, what happened. Look at just now the restructuring story unfolding in Aditya Birla Capital. You saw the re-rating happening. You saw GHCL. So I would certainly suggest that more than just sectors, because sectors needs a lot of knowledge and it needs to be spot on in entry and exit.